Right now, all across the United States, a building that used to be one of the most trusted places in any neighborhood is disappearing at a pace most people haven't fully noticed. The local bank branch, the place where you opened your very first savings account, where a teller knew your name, where your parents took you to deposit birthday money as a kid. In 2026, several of America's biggest bank chains are closing branches by the hundreds. Today, we're looking at six major American bank chains shutting down locations right now, and the bigger shift in how the country actually handles its money. Before we get into the list, here's the scale of what's happening. According to federal banking regulators, more than 6,000 bank branches have closed across the United States over just the past 5 years. Industry researchers reported that in a single stretch of 5 weeks in early 2025, Chase, Bank of America, and Wells Fargo alone closed a combined 145 branches between them. Analysts have projected an additional 4% reduction in the total number of branches nationwide by the end of a single year. And maybe the most telling statistic of all comes from banking industry research showing that only about 9% of consumers now say they prefer using a physical branch for their everyday banking needs. This isn't really a story about banks failing. Most of these institutions are enormously profitable. It's a story about a building that used to be essential, slowly becoming optional for almost everyone. Some of the names on this list might surprise you because several of these are among the most profitable financial companies on the planet, reporting billions in quarterly earnings even as they quietly shut branch after branch. That's actually the most important thing to understand before we start. This isn't a story about weak banks. It's a story about strong banks making a very deliberate choice. Regulators have described this shift using a specific term that's become increasingly common in banking policy discussions: banking deserts, communities where the nearest physical branch of any bank is now a long drive away rather than a short walk. Research on this trend has consistently found that the communities hit hardest tend to be lower income neighborhoods and rural areas, exactly the places where residents are statistically less likely to have reliable broadband access or feel comfortable managing money entirely through an app, and exactly the places where a bank closure can mean losing convenient access to cash, safe deposit boxes, or someone to sit down with and explain a confusing fee. Number 6. Citibank. For decades, Citibank was one of the most recognizable names in American banking, with branches in major cities that felt like a fixture of the urban landscape, especially in places like New York, Chicago, and Los Angeles. Citibank has been quietly trimming its physical branch network, with federal filings showing a dozen or more closures in recent tracking periods alone. Unlike some of the other names on this list, Citibank has been deliberately shrinking its consumer retail footprint for years, having already sold off large portions of its retail banking business in several international markets to focus more heavily on wealth management and institutional banking. What's happening with Citibank's branches fits into a broader strategic retreat from being a mass market, everyday retail bank with a location on every corner. Instead, the company is increasingly betting on serving a smaller number of higher value customers through fewer, more specialized locations, while pushing basic day-to-day banking almost entirely onto its app. For longtime customers, that shift has been noticeable. The branch that used to handle everything from opening an account to resolving a dispute in person has, in many neighborhoods, simply stopped existing, replaced by a phone number and an app that assumes you're comfortable managing your entire financial life through a 5-inch screen. Number 5. TD Bank. TD Bank built much of its identity around convenience, longer hours than most competitors, weekend availability, and a friendly community bank feel, despite being one of the largest banks in North America. But TD Bank has been named repeatedly on federal branch closure lists throughout 2025 and 2026, with 11 or more locations shutting down in recent tracking periods. The bank has also been dealing with regulatory scrutiny in the United States after a major anti-money laundering settlement, which has pushed leadership to tighten operations and cut costs across the network. For a bank that built its brand promise around being open when other banks weren't, trimming its physical footprint is a notable shift. It suggests that even the specific advantage TD spent years marketing, being the bank that's there when you need it in person, isn't enough anymore to justify the cost of keeping every location open. Longer hours cost money no matter how few customers actually walk in after 5 p.m. Every additional hour a branch stays open means paying staff, keeping the lights and security systems running, and covering the lease regardless of whether 10 customers or 0 customers show up during that stretch. When digital banking chips away at the number of people using those extended hours, the economics of staying open longer than competitors stop making sense, no matter how good it looks in a commercial. Number 4. Capital One. Capital One grew into one of the largest banks in the country in part by rethinking what a bank branch even needed to look like, replacing traditional teller counters in many locations with its Capital One Cafe concept, part coffee shop, part financial center. Despite that reinvention, Capital One has closed 27 branches according to recent federal tracking data. The Capital One Cafe model was originally seen as an innovative way to keep foot traffic coming into physical locations by giving people a reason to stop by that had nothing to do with banking. But even a genuinely creative attempt to make the branch relevant again couldn't fully offset the underlying trend of customers simply doing more of their banking from their phone. People might enjoy grabbing a coffee at a Capital One cafe on a Saturday morning, but that's a fundamentally different relationship than needing to walk into a branch to deposit a check or open an account, which is the kind of routine visit that used to guarantee foot traffic for banks, regardless of how appealing the space was. Capital One's struggle shows that reinventing the branch experience can slow the decline, but it hasn't been enough to reverse it. Number 3. PNC Bank. PNC built a strong regional presence across the Midwest and Mid-Atlantic, becoming one of the largest banks headquartered outside of Wall Street, and a dominant player in cities like Pittsburgh, Cleveland, and Cincinnati. But PNC has closed 30 branches according to the most recent federal closure tracking, placing it among the most aggressive branch cutters in the entire industry this year. What makes PNC's situation notable is that it isn't a struggling or distressed institution. It has continued expanding into new markets across the country, even while trimming its existing branch network, which shows this isn't really about financial trouble. It's a deliberate strategy of closing older, lower traffic locations in mature markets while redirecting that spending toward newer branches and digital infrastructure and markets it considers higher growth. In other words, PNC isn't retreating from physical banking altogether. It's making a calculated bet about which specific locations are still worth the overhead, treating each branch less like a permanent community fixture and more like an individual investment that has to justify its own existence on a spreadsheet, market by market, block by block. Number 2. Bank of America. Bank of America is one of the largest banks in the country, with a branch network that for decades felt like it stretched into nearly every town of any meaningful size in America. According to recent federal tracking data, Bank of America has closed 36 branches, and earlier reporting this year noted the bank confirming 5 additional closures on top of a broader wave of 74 closures already announced. Bank of America has been explicit about its strategy, framing many of these closures not as pure cost-cutting, but as part of a plan to open newer, more modern branches in different locations while shutting down older ones that no longer fit customer traffic patterns. Whether that reshuffling nets out to more or fewer total branches over time, the visible effect in a lot of communities is the same. A familiar building with the Bank of America logo going dark, sometimes with a promise that a newer one is coming to a different part of town, sometimes without one at all. That distinction matters less to the average customer than it does to Bank of America's investor presentations. Whether a closure is labeled a strategic relocation or simply a cutback, the practical experience for someone who has banked at the same corner branch for 20 years is identical. The building they know closes, and they're left figuring out where the nearest replacement actually is. Number 1, Chase Bank. Chase, part of JP Morgan Chase, is the largest bank in the United States by assets, and for a long time it also had one of the most aggressive branch expansion strategies in the industry, opening thousands of new locations over the past decade, specifically to grow its physical footprint. Which makes it especially significant that Chase now tops the federal closure tracking list with 40 branches shut down, more than any other single bank in the country. For years, Chase's entire competitive strategy was built around having more branches in more neighborhoods than anyone else, treating physical presence itself as a selling point. Seeing the largest bank in America, the one that spent the last decade expanding its branch count faster than almost anyone, now leading the country in closures is one of the clearest signals in this entire list. If even the bank that bet the hardest on physical locations is now cutting them faster than its competitors, it suggests the entire industry has quietly reached a shared conclusion about where banking is actually headed. It's worth noting that Chase, even while closing branches in some markets, has continued opening new ones in others, particularly in regions of the country where it previously had little to no presence at all. So this isn't necessarily Chase shrinking overall. In many cases, it's Chase reshuffling its national map, pulling out of neighborhoods where foot traffic has dried up and pouring that same investment into new metro areas where it sees room to grow. But for the specific communities losing their local branch, the strategic nuance behind a nationwide spreadsheet doesn't change what they're actually experiencing. Now, here's the part that makes this story more complicated than a simple list of shutdowns. While traditional branch networks shrink, several digital-first and online-only banking companies have been growing rapidly during the exact same period. Fully digital banks and fintech companies with no physical branches at all have been adding millions of new customers, offering higher savings rates and lower fees precisely because they don't carry the enormous overhead of maintaining thousands of physical locations, security staff, and in-person tellers. Credit unions in many communities have also been quietly picking up customers who specifically want some in-person option, but are frustrated watching their previous big bank's local branch close down. Some of these digital-only players have grown their customer base by the millions in just the past couple of years, built almost entirely on the argument that a bank doesn't need a building at all to hold your money safely, pay your bills on time, or send you a debit card in the mail. For a generation of customers who have never once needed to speak to a teller, that argument is landing. Looking back at this whole list, the pattern across the American banking industry looks similar to what's happened in retail and grocery. It's not that people stopped needing banks or stopped trusting them. Deposits at these same institutions remain enormous, and most of them are reporting strong profits. What's disappearing is the assumption that a bank needs a physical building in walking distance of every customer to stay relevant. The research showing only 9% of consumers now prefer branch banking as their primary method explains almost everything else on this list. When the vast majority of a bank's customers are perfectly happy never walking through the front door, keeping thousands of buildings open across the country stops making financial sense, no matter how profitable the underlying bank remains. The institutions that figure out how to serve that shrinking but real group of people who still want in-person service, without bankrupting themselves maintaining buildings most customers never enter, are the ones that will decide what a bank branch even looks like a decade from now. For more than a century, the number of branches a bank operated was treated as a rough proxy for how big and trustworthy that bank actually was. More locations meant more reach, more customers, more legitimacy. That entire assumption is being quietly dismantled right now, one closure notice at a time, by some of the very same institutions that spent decades building their reputation on it. Is there a bank branch on this list that closed near you or one still open and busy in your neighborhood? Let me know in the comments. I'd love to hear how this looks where you live.